All right, everybody. Welcome to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a very special guest here with us, Mark Willis. And we're going to hear some very interesting concepts from Mark. And Mark's a man on a mission to help people think differently about their money and your financial future. And Mark has a pretty interesting story after he graduated with six figures of student loan debt, and he was able to find a way to turn his debt into real wealth. As everybody in 2008 kind of lost their retirement savings and home equity, and kind of pivoted from there. And now Mark is a CFP, certified financial planner, and a two-time number one best-selling author. And right now he's the owner of Lake Growth Financial Services based out of Chicago. And he's helped hundreds of his clients, kind of take back control of their financial future and build their business through proven tax-efficient financial solutions. And part of that is real estate investments. And, he's actually a host of his own podcast, Not Your Average Financial Podcast, which you should definitely check out, subscribe, rate, and review. It helps out a lot of podcasters to get our exposure out there. And today we're going to be talking specifically in regards to the self-banking strategy. And I know I have a little bit of knowledge around it, but Mark's the expert. I definitely want to learn and hear from Mark and for him to educate our audience. So Mark, thank you so much for coming on the show.
Yeah, thank you, Anthony. I appreciate it. Glad to be on the show.
Great. So can you kind of, hopefully I gave you a good introduction, kind of talk about your past in terms of your student loans and how you're able to overcome that. I'd love to hear more about that.
It was a long time ago, all of 10 years ago. However, Valentine's Day seems like a lifetime ago at this point. In 2020, we're recording this in late May. But yeah, it was a ton of debt. We went through our undergrad and then our graduate school degrees, and my wife and I left school with $120,000 of student loan debt, with no real plan, Anthony, to pay it off. I mean, really, we had no job. We still had the employee mindset. We still had, a major student loan payment, and in the midst of the Great Recession, had no real way to pay it off. And so for us, it was a wake-up call. I'd never really budgeted before. I'd never really paid attention to income. You're just sort of handed a bunch of money when you go through school. So I jokingly say I married two women in college. I married my beautiful wife, and I married Sally Mae at the same time, or she married us. We didn't exactly want her in the relationship, but she was there, wanting money every month, demanding money every month. So yeah, it was a moment of reckoning, and we had to decide for ourselves if we were going to take this money thing seriously or if it was going to take us out. And thank goodness it was a light bulb moment for us, an aha moment. We became very interested in personal finance. I worked at that time for a CPA who worked with her clients all around the country, nationally recognized, very prominent CPA at the time, doing investments and taxes. I mostly helped out with the tax planning for her, but it was amazing to see, and unfortunately terrifying to listen to some of her phone calls to her clients at the same time. So I was dealing with my mountain of debt while at the same time hearing her make those calls saying, "I'm sorry, Mr. 63-year-old client, but I just lost you half your life savings in the midst of the Great Recession." That was my introduction to the financial planning industry. Okay. So it was sort of like being dropped into the front lines of a war and watching paper wealth get lit on fire, essentially. 401ks becoming 201ks, people losing their jobs at the wrong time. And now we're in another round of this all over again. Anthony, we've had 3 major market corrections just since the year 2000. So that brings us from the past to the present, and maybe even to the future. Many people say, Mark, is this ever going to happen again? Or what can I do to protect myself? And the first is just recognizing that these are cycles that happen. This is not the last time. I don't know if it's going to be another virus, but I do know that markets tend to have cycles, ups and downs. And what are we going to do next time different than we're doing right now or last time?
Sure, absolutely. Even without coronavirus, we were due for a correction for a long time.
You bet. Yeah.
So
Yeah,
100%
I
agree.
would say the coronavirus was merely the pin that pricked the bubble. The bubble was there. In fact, we were sick financially well before Corona came around. Corona, unfortunately, and God be with the people who've been sick and impacted financially, but we were already financially sick way before. I mean, our debt load was higher than it was at the peak of the 2008 crisis in 2019. And we have more debt per household as a percentage basis than we had even 10 years ago. So we couldn't have handled a light drizzle, and financially we got a torrential downpour.
Sure, sure. No, absolutely. And so, Mark, could you see, you gave kind of your background, and that's great. So, could you kind of talk about some of the strategies that you've been mentoring your clients around in terms of preservation of wealth and to weather the current storm and when the next storm does come?
Well, sure. Yeah. There are over 450 financial products that I was able to track as I went through my CFP training a couple years ago, many years ago. And it's overwhelming when you're going through that training process because it does feel like you're just drinking from the fire hose a little bit. What is the right place or places to keep my cash? That was sort of my own personal question as I went through my studies for the CFP and for my clients. I didn't want to build a big house of cards, for clients. If I was going to start a financial firm, only to have the same phone call that I was listening to that CPA make when I worked for her. So we did start a practice, Lake Growth Financial Services, in 2011, 2012. And it was in the midst of that recovery period that I was asking myself, I don't want my wealth to be tied up to a roller coaster that might or might not be there when I go to look for it. So I was desperately looking for two things: a place to build real wealth in any economy, and a way to pay off my debt in a way that didn't just leave me with a bunch of thank you notes. You know, what's the result of paying off all your debt? Well, you get a bunch of thank you notes. Thank you for your payment. But the problem with paying off all of our debt, Anthony, was all we had were paper thank you notes, right? We didn't have anything earning for us and no assets, nothing. We were essentially crawling and scratching our way back to the starting line of our life. And that was going to take us many years to get there. So what we decided was, what could we do to build real wealth right now that would also be there as a leverage piece to help us wipe out our debts at the same time? How could we turn our debt into real wealth? Not paper wealth, but real wealth. And, I searched and studied and looked. I was on the hunt for a long time. And it was actually a mentor of ours that brought this concept of self-banking to our attention. And bank on yourself is what we refer to this as. It's a mindset shift, learning to think like a banker. It's also tied with it, not just a mindset, but a number of tools, financial strategies, and products that you can use to help augment and actually become your own source of financing, so that when the next downturn comes and banks stop lending, or the next time you need access to a large amount of capital for a real estate deal or to pay off your debt like we needed to do at the time, you have all the cards because you are the banker. When you're thinking like a banker, you have control of the entire financial environment. If you guys think about this for a minute, what is the biggest, most expensive, most incredible building in your town, wherever you live? Well, it's the bank, right? Almost every single time, at least, every town I've been in, the biggest building is the bank. In fact, look at the Federal Reserve Building in Washington, D.C. By far, it is the most glorious building in town.
Sure.
And that's not on accident, by the way. That is not on accident. So if you're looking for the best way to build wealth, just start a bank and and build capital. FDIC insured banks. Sometimes that takes $100 million and 10, 20 years to wait for a bank charter. But if you could do that, that's a great business to get into. And here's the good news. You're already, or bad news, depending, you're already in the banking business. You, me, Anthony, all of us listening, we're already in the banking business. We're just sitting on the wrong side of the desk. So we have to ask that other person to politely leave the banker's position and step into it ourselves. By insourcing our banking function, everything else becomes easier. I would say that whether or not you are the banker has more to do with your financial success than what your mutual funds got you last quarter, what kind of debt load you're carrying, what sort of lifestyle you're living. As long as you are the banker, it's the smallest hinge in your portfolio that can swing the biggest door. And I'm all about finding those small things that can create the biggest impact. That gives you the most control. Everything else is secondary. What's my cash on cash return on my rentals? That's great. I'm good for that. I want that. High rates of return, great. But if I can control the entire environment where my money lives like a bank, then everything else becomes secondary.
Really interesting. So can you talk a little, let's dig a little bit more deeply in that, infinite banking concept, because I've heard it before and you're talking about it now to some extent, although there's various different ways you can implement those strategies. But for my listeners who are real estate investors, what would be your suggestion, whether it's they want to get into a real estate deal, and now we're in the midst of coronavirus, so liquidity is a concern of mine and a concern of a lot of other investors. Having that liquidity when the actual depressed properties really do come out, because we haven't really seen it yet, and kind of holding onto the cash until that happens. Who knows? But there still are opportunities now that are still, on a risk-adjusted basis, still achievable, to make sense even with the downturn. So can you talk about just some of the strategies that people are using or to tapping into other sources besides cash?
Sure. Yeah, you're right. Liquidity is important here. I think they used to say cash is trash. I'd say that's no longer the case. In the midst of downturns, it's those that sit on liquid piles of contingency capital, both for emergencies if you do lose your job, or opportunities if you do find that great deal, that property on sale, so to speak. And you're right. I think it was Mark Twain who said, "A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain." And so
Sure.
the problem is liquidity is least available when we need it the most. That's the whole point. When are we least likely to get access to capital? Well, during a crisis. When are we most likely going to need capital? That's right, during a crisis, right? And when are we most likely going to have a hard time getting access to it? Yeah, during a crisis. And when is it going to be hardest to sell our real estate at a fair price? During a crisis. So it all blends together. And you're right, we need to think about where our money lives. We need a place for our money to live, Anthony. Our money has to live somewhere. So where's the right place for it to live for our real estate deals? So, I'd invite your audience to kind of just have this thought experiment with me for 90 seconds at least. I'd say take an afternoon at least to think about, where do you want your money to live? If you could wave a magic wand and create a brand new financial vehicle that had every characteristic that you ever wanted your money to do for you, what sort of characteristics would you want it to have? So just ask yourself that question. Here were some of my own answers. I wanted some sort of predictable, competitive rate of return. I wanted easy access to the money where I didn't have to beg a bank to go get it, or get penalized, early withdrawal penalties, or pay my taxes to get the access to my own money. I wanted some sort of safety and predictability so that I'd know that that money was there when I went to go look for it, not vaporized like, might happen with the stock market. I want some sort of tax favored access to the money. So like I want it deferred my taxes every year, where I'm not getting taxed every year. And I want tax-free access to the money anytime I want it, now and in retirement. I want it to be a absolute, I'm talking like just shoot for the moon here. What's the coolest, most maybe on the verge of illegal sounding, right? I wanted it to be legal, but I wanted every last best case. And I was going through my CFP trying to find this, check all the boxes, right? Well, of all things, at the end of the day, it was a whole life policy that allowed us to do everything that I just said. Now, not the kind of grandfathered in, grandpa's dusty old whole life policy. I'm not talking about that. Not talking about the kind that Dave Ramsey and Susie Orman love to hate on. We're talking about an augmented, modernized form of dividend-paying whole life insurance, where the commissions have been cut dramatically, the expenses and the death benefit have been cut dramatically in order for us to flood most of our money, as much as we possibly can, into the best part of the whole life policy on this side of heaven. And that is the cash value. And I say on this side of heaven because once I die, my family does still get a giant, huge income tax-free death benefit, which we don't want to forget about. But before I die, it's a lot more fun to spend my money before I die, right? At least I think it is.
Yeah.
I'm interested in how much wealth can I build on this side of heaven. My cash value is my living benefit. The death benefit's there for my family. That'll be great. I'm sure they won't mind receiving millions of dollars, tax-free, income tax-free. But on this side, I'm looking at how can I build a living asset, a benefit to me that and my family that we can use as a source of capital on the balance sheet of our business or our family that we can use as a source of capital for making major real estate purchases. And that's exactly what we do. We have used our almost 10 policies now that we are accumulating and building for our portfolio for various real estate deals. And it's a guaranteed cash value that is there for you without fail during any market correction or downturn like we've experienced earlier this year. That's the first piece. Is it grows on it's guaranteed principal, but it also grows on a guaranteed basis, Anthony, every single year. That's the first piece. Second of four, I'll just give you four quick things, then I'll hush for a minute. Second piece is that it is available under current tax law without any taxes due. So it's a tax-free source of money anytime you need it. Both the principal and the gains can be accessed without any taxes due, much like a Roth IRA. Although the gains, we'll talk about how the loan feature works here in just a minute. The gains would be accessed via loan. The third piece is it is a line of credit to yourself. You can treat it like a bank. It's not truly an FDIC insured bank. It's a life insurance policy, of course. But you can treat it like a bank in that you have a line of credit to yourself that's guaranteed by the insurance company. They cannot take that money away from you. It's your cash. It's a guaranteed line of credit when the banks stop lending. And a lot of our clients have $500,000, several $1 million in cash value right now. Guess what they're doing? They're finding deals or they're waiting for the better deals, and when everyone else is having a more difficult time, and we expect the same as you, Anthony, to see more deals pop up this year, who's going to be the ones that can pick those up? It's those with cash. And that's exactly what the policy allows us to do. Now, what's really, go ahead.
No, keep going. I have a question.
What's really bananas about this is when you borrow from these life insurance policies, when you borrow from the policy itself will continue to grow and compound even on the capital you borrow, as if you had not touched a dime of the money. So just a quick example. If I've got $1 million cash value and I borrow $400,000 to go buy a multifamily or something, down payment or whatever it is, that year I'm still going to get the dividends and guaranteed cash accumulation on the entire $1 million, as if I had not borrowed against the policy. And that to me is better than paying cash for deals.
Very interesting. So a couple questions. The first one would be, if you are in the sense of a real estate investor and myself, it sounds like if you want access to that liquidity, you're borrowing against your policy. Am I correct or am I wrong?
Correct.
Yeah. Now, if there's an investment that's offering an 8% return, what are the typical rates that you are borrowing against your policy at? Is it as high as 7-8%, or is it much lower?
Yeah, it's a good question. So, first of all, when you borrow from these policies, you can usually get the money in your bank account within about 5 business days. There's no fees or gotchas or loan origination paperwork. There's no closing costs to get this loan out. So unlike a HELOC or cash out refi or something like that, there's no price to get the money out. The insurance company is not doing this for charity, of course, Anthony. So there is a loan interest rate when you borrow against the policy. Over a 4-year period, and that's an important sentence right there, but over a 4-year period, they charge a simple interest schedule all year long. So over 4 years, the true APR on a policy loan is about 1.9%.
It's nothing. Yeah.
Yeah, cheap money, right? Now, I say simple interest, and now if it was 2 years, it might be closer to 0.9%, and if it's over 8 years, it might be closer to 3%, just to give you a ballpark. But at the same time as you're getting that charge, on your policy loan, some people are like, well, Mark, why would I pay interest on my own money? And you're really not taking your own money when you borrow from a life
It's a
insurance policy.
policy.
You
Yeah,
got it. Yeah, you're using that policy as collateral for money that came from the insurance company that you and I own together. So
sure.
remember, that policy is still building and earning dividends and interest, and that interest includes some of that loan interest that we paid.
Makes a lot of sense. So,
Yeah.
so my follow-up question to that would be for some of my listeners that let's say they don't have a whole life policy in place. Now, how long would it take, let's say, to build up, you use an example, I think 500 grand, right? How much money do they have to dump into the policy in order to get that cash value accumulation? Like, and how long does it take?
Yeah.
That's, yeah,
Man, it all comes down to capitalization. Don't be afraid to capitalize is one of our major tenets and mindsets here. The old way to think about life insurance was how little premium can I pay for as much death benefit. And what that ends up creating, that mindset creates an outcome, and the outcome is very little cash value to use. So we really can't use the old-fashioned whole life because there's nothing much cash value in there to spend or use, right? The new way to think about life insurance, at least bank on yourself type life insurance policies, is how much premium can I pack into this thing for as little death benefit as possible? And by doing it that way, to answer your question, it all comes down to the premium. How much premium, i.e., contributions you're putting into your policy, have you put in there? Maybe you're putting in 100 grand a year and it took you a couple years. Maybe you put in 500 grand, 600 grand day one, and you can have that cash value of 500 grand within 30 days. It just comes down to how you funded the policy. I just spoke with a young guy and his dad earlier today. They're dumping in 300 grand into the policy, and they're going to have a $250,000 ready to go before the end of June, which would be about 30 days from now. So it all comes down to how we funded the policy. Some people are just able to scratch together a little bit of money every month, and so it's going to take them a long time to build up some sort of large asset they can use. But Anthony, every story is different.
sure. And at the same time, it's facilitating what the purpose of the whole life is supposed to be used for, which is insurance. So if you're able to use that and leverage basically your lifestyle,
Yeah.
and obviously in a smart way, to build up your wealth, I think that's really, really smart. Is this a new concept, Mark, or has this been around for a while and nobody's really talked about it?
Yeah. It's a good question. I feel like the wealthier the individual I'm speaking to, the more likely they've already heard of something like this, or have heard of exactly this. You could go back 200 years and see whole life insurance has existed even before the U.S. Constitution was inked. But I'd say in general, we bought into the stock market's allure. There's a lot of reasons for that, Anthony. We could get into why we became a nation of speculators in the late 70s and early 80s. But the bottom line is our grandparents probably had something like this and used it for their major purchases. I mean, you don't have to have $500,000 to use this policy, right? My first two policies, my wife and I, $500 a month going into the policies. We used our policies within just a few months to cover an emergency medical expense we had, a couple $1,000. We needed to grab that money out while we were paying off our debt. Now, if we'd been following Dave Ramsey's method, we would have had to grab a credit card or something to help cover that broken foot that we had. But we had it in our policies. We were plowing everything. We were still paying our minimums and all of our student loans and all that was still being taken care of. But we'd been building up this asset and these policies, even a modest amount every month. And that allowed us to cover our lifestyle need, our medical expense. It also helped us buy a car in the meantime. We even went on a month-long trip to Hawaii using our policy. And while we were there, we got dividends on that policy for the policy that we had just borrowed all the money out to go on that trip. And then, of course, at the end of the day, Anthony, it allowed us to wipe out all of our student loans, but be better than debt-free, right? Right? When you use your policy to wipe out your debt, we call this the debt snowbank method of paying off our debts. Not the debt snowball method, the debt snowbank method. When you use your policy to wipe out your debts one at a time, your policy is still earning and growing as if you hadn't touched a dime of the money, and your student loans are paid off, right? You bought back that debt. Now I'm the banker to myself, which is the best feeling in the world, because I'm
Sure.
in control at that point.
Sure. It makes so much sense. Surprised more people haven't, like you said, the wealthier you are, yes, you probably heard
Yeah.
about it and maybe you're not implementing it, but it sounds like most individuals, whether they're wealthy or not, they do have some sort of life policy in place, mid 20s, early 30s,
Yeah.
whatever it is, or at least start to think about that. And, there's probably a lot of hesitation, but if you can um, educate, people and advise them that it is a liquid asset and you are able to basically use it for your objectives, that's a whole different scenario. So most
Right.
people don't think that way.
Well, yeah, you're right. And if folks want to just Google bank owned life insurance, or BOLI as they call it, I'm seeing some here. Looks like there's a total of $190 billion in total assets at tier one capital at the banks on their balance sheets of life insurance cash values. That is their largest source of safe money that the banks themselves use. In fact, they're required to have life insurance as a source of capital for their own lending purposes to be considered a bank with an FDIC insured charter. So if the banks are doing it at such large, huge volumes with their safest money, what are we not knowing that they know? And I've always told folks, don't do what banks tell you to do with your money. Watch what they're doing with their money and go do that instead.
Makes a lot of sense. So we're going to wind it down a little bit here, Mark, on our program. And usually I ask three quick questions at the end to wrap it up. And the first one would be, and maybe you'll say your book, but do you have a favorite business book or real estate book that you've read recently or just in your lifetime that helped shape your new life?
Yeah, sure. I really do think the Bank on Yourself Revolution, I didn't write that one, Anthony. Pamela Yellen wrote that, New York Times best-selling book. The Bank on Yourself Revolution. It's one of my favorites. It's the user's guide. It's the manual for this strategy. And I would say again, just to wrap up as we're wrapping up, don't just go run out and get one of these policies or think it should be a good fit for you. I don't know every person listening. I don't know every situation. There's obviously insurance costs. There's obviously reasons not to use these policies. I don't think this is some sort of silver bullet that fixes every problem, but man, it's a great tool if it's handled correctly. So book, Bank on Yourself Revolution, go check that one out.
Great. And you have a mentor that kind of guided you to learn all these concepts?
Well, it was our mentor from college, Kent Smith, who kind of introduced me to this. He was a professor, didn't have any skin in the game except just his love and care for my wife and I. Really a great mentor and friend. Still think he's the coolest guy I know. So just listen to your mentors, guys. That's whoever they are. Even if it goes counter to what you believe. Like my arms were crossed when I heard about this. My mind was shut. All I could hear was Dave Ramsey in my head. And my mentor had to say to me, Anthony, he said, Mark, is it possible Dave Ramsey could be wrong about something?
Yes,
And he just
sure.
let that question hang in the air. And that was my opening into this brand new world.
Sure. Very smart guy, but he has a purpose for some audiences he serves, and
Yep.
it's not right for everybody.
That's right.
You're 100% correct. And so outside of the CFP world, do you have any hobbies? What do you do for fun?
Man, just yesterday I was out in the woods walking with my daughter out in the woods and just loving listening to those woodpeckers and the different birds. So hunting through and hiking through new terrain. That's one of my favorite things to do.
Awesome. Well, Mark, thank you so much for coming on. I'm going to have a link to your website and your LinkedIn and all your profiles in the comment section. And feel free to check out Mark's podcast. Like I said, Not Your Average Financial Podcast. You're still doing that, correct?
Yeah, Not Your Average Financial Podcast. And if folks go to growmorewealth.com, they can find all the links that you'd need there, growmorewealth.com.
growmorewealth.com. And we'll have that in the comment section as well. So thanks again, Mark, for coming on. We really appreciate it and hope to have you on again here within the year or so.
Fantastic. Thanks again.
All right, Mark. Thank you.